Friday. Thank goodness it is Friday.
Hi, happy Friday, everyone.
Oh, yes. Okay.
It's time for Finance Friday. We need like a jingle.
You have that when you call. You get a jingle when you
That's
call her.
true. If you call and you get our hold music, you get a jingle.
You get a jingle.
Okay, welcome to Finance Friday. This is the show where we give you the information you need to help you create, grow, and protect. I was told to slow this down. Your wealth.
Okay, that works.
I'm Amy Novakovich. I'm a certified financial planner and a chartered retirement planning counselor. And this is
Beth Henchesmore.
Yay.
Were you going to say the
I
other
was
name?
going to say Bethany. No, I just always want to say Bethany, even though
No,
I never call her Bethany.
Unless I'm in trouble, so let's not go there.
No, I really don't.
No.
We are going to address the big elephant in the room of the market is high, the market's going to drop. Am I going to lose money? How do I make money on a drop? What are the odds of a drop?
Right.
You know, all these questions of what's going to happen with my money because we're hitting all-time highs. And we have been hitting all-time highs for a while. Like, that's the issue, is you never know where the last all-time high is.
I'm sharing this, by the way. I'm listening to you. I'm just sharing it.
I need to share it too. Yes, share it out, because you know somebody. You certainly know somebody. See, you know, I have to like go search Nova Wealth Management, and then it says live. Oh yeah,
You're
there
not
we
looking
are.
at us enough.
Right? Is that it?
Yeah.
Share.
Share it now.
I shared it. You definitely know somebody who has these questions of, am I going to lose money in the next market drop? Should I be going more conservative because the market's going to drop? It doesn't matter what age you are. You're not exempt from thinking about your investments, the market, things of this nature, right?
Right.
I mean, what would you say? I would probably say this is the most common concern that we get. But you talk to a lot of people too. Like, what are you hearing when you call, like, after our workshops? Is this one of the
Maybe
top
what-
three concerns, do you think?
It's usually the couple questions that we get. One, in our seminars that we do, our workshops that we do, we remind people that when you can't time the market, because you got to be right, as you call it, twice. You got to be right when you get into the market and right when you get out.
Yeah, when
And-
she means time the market, she means like
Oh.
going to cash,
Going to cash,
and then
sorry.
going back in.
Right.
That's what she means. Like,
So-
we just certainly don't recommend that.
Right. So you say that, like, you got to be right twice.
Right. It makes it hard. It's hard enough to be right once.
So the people that book with us tend to be like, okay, I'm not getting it right. I've been wrong, and I've probably missed out on some returns because I've been reactive instead of having a financial person who prepares us for when markets do corrections, when they do these 10% drops, I guess you want to call
Right.
it. Yeah.
Well, and it helps to have a plan, right? Like, you don't want to have the advisor that's just like, you'll be fine, just write it out, it always comes back. No. Let's have an action plan if and when the market drops. Instead of being reactionary, let's talk about the plan ahead of time. So, what I have found in the statistics is what confirms my thought process. So, on a given year, on any given calendar year, you have a 50-50 shot if you're going to have a 10% decline in a year. Every year, guys. So if you have an advisor that's just like, just stay the course, yes, that's fine. But how are we going to take action either against it if we know you're not a risk taker? What are we going to do to make sure you can sleep at night? Make sure you don't make dumb decisions of trying to go to cash,
Correct.
right? Because we know what's going to happen.
People are emotional with money.
Yes, I mean, it is emotional, right? Okay. You have a 1 in 4% chance. A 1 in 4%.
I know what you meant. 1 in 4 chance.
25%, 1 in 4 chance of having a 20% decline in a year. We had one this year. Very quick. It was a very, very, very quick
It was.
correction between February and April 7th or 8th. And so now we've had this quiet run, right? So after 6 months of stability, you have a 40% chance of a 10% decline. And after 12 months, you're back to 50-60% chance after this quiet market, quiet before the storm. So what do you do in preparation for something we know is going to happen? Number one, even if you're super, super aggressive, we say don't have everything in the market because we need to buy on the dip. We always talk about that.
Yep, gotta have some cash in there.
We always say we gotta have, what do we call it? Dry powder. We just always want to have some money to buy with to take advantage of downturns because there's always some deals out there, right? So therefore, number one, that calms the nerves of somebody that's like, what do I do? And you're being told, just chill out. It'll be okay.
That doesn't ever help calm people.
It really doesn't.
When you're upset and somebody says, calm down, it doesn't work.
No, it really doesn't. So we want to buy on the dips. And how much are we going to buy? Well, that determines on your risk. So how much are we going to leave out of the market to buy with? How much are we going to buy when the market is down? That's plan. That's investment planning 101. So this is how you make sure you're not going to freak out or panic. You're like, oh, I knew this was going to happen. And I know what my advisor is doing about it.
Right.
Right? So, and there are some clients, don't get me wrong, that just don't want to hear it. I have plenty of clients that are like, just don't tell me.
Yeah, just don't
Like,
tell me.
I just don't even want to know.
Manage my account, don't tell me.
And I understand. That's fine. It doesn't mean we're not going to do it. And it doesn't mean that in our reviews, we're not going to talk about how we're trying to buy on these dips, right? Okay, so the second thing you have to do. So we first number one, remember we have a plan. We have an action plan. Number two, I guess this one actually could have come first. You need a risk assessment, whether it's a discussion with your advisor or a questionnaire, a combination of both, historical experiences. Like, remember, my first rodeo in college was psychology. I ended up only minoring because I I decided to move from Wisconsin to Florida and lost a bunch of credits, so it ended up being my minor instead of in finance.
Smart move to Florida, by the way.
I know, right? I'm so happy about it. But psychology means you have to kind of go through the history. Emotionally, where have you been? What have you been through? Because there are some people with very traumatic experiences from different times in the market, 2008 being one of them.
Yes.
Right? So we have to kind of understand where we might be headed. And in order to do that, we have to understand where we've been. Okay? So we have to go over risk. So we're going to talk about history. We're going to talk about emotional responses to what has happened in the past. We're going to talk about income. Like, what do you need? When would you might need this money? That goes into risk. Believe it or not.
It does.
If you're going to need this money in the next 5 years versus, I'm probably never going to touch this money. Big difference in risk, regardless of, what you feel.
Right.
Or how many times have we had a risk questionnaire come back and it's like a 30 and we're like,
No.
Nope. You need to be a little more than that.
She's talking about, we have this program,
yes.
And it's on our website. So you go to our website there, I think it's under resources. I think it says know your risk. And it will take you to a different site where you can plug in the numbers and there's questions that it asks you. And it's not a bad checkup, even if you're not one of our clients. It's a great spot to go and just see how you score on a 0 to 100, that range of how risky you are.
And you can put in a dollar
investment.
amount, and it'll show you what that range means.
You can. So you can say, I have about, X money of dollars that are going to propel me through my retirement.
That I'm willing to invest.
That I'm willing to invest, yes. And this is what I could... It asks, I think it's like 5 questions, right? And it says, do you feel comfortable?
It's not a lot.
Yeah, it's short. We actually did it... my husband's... Well, he asks me every Monday when he can retire. But that's his fault for marrying somebody with kids that are still in school. But we did his risk score, I think it was like 5 years ago. It was right around COVID. I think right before. And he thought he was 1, and the risk score showed him something completely different. It was very eye-opening for him. He actually adjusted
his risk.
Yeah, he did. He adjusted his retirement, and he was
It
so
warrants
thankful.
a discussion, though.
It
Like, the questionnaire isn't an end-all, be-all. It just
No.
kind of gives you a starting point.
He did it more than once. I think he did
Yeah.
it like 3 times.
Just
Going
if you come up
because
with
he's
the
like,
same
no,
answer.
I'm not like that at all. Yes, you
Yeah.
are. You are. So it was helpful for him to be like, oh,
Maybe
okay,
I am.
maybe I am, and it did work out to his benefit. So anyway.
Yeah, and we certainly, remember step number 1, so we're coming up with the action plan, and then we're talking about risk, right? So, and I probably do want to flip-flop those. We probably should have the risk discussion first and then come up with the plan.
Right.
I guess the reason why I said plan first is because it's a no-brainer that you need to have somebody buying on the dips for you. It's a no-brainer.
Correct.
We know they're going to happen. The highs get higher and the lows get higher. Like, everything's going higher. So yes, it's fluctuating, but everything is just going up and up and up, and you're never going to get these chances to buy at these levels again when there's a dip. So like the last dip, significant dip, COVID, The Dow hit 18,000, guys.
Yeah, that's
In
right.
March of 2020, it was like 18.5. You're never going to see that again. So if you didn't have somebody buying for you, again, regardless of risk, that's why I say plan is first, is because you have to have an action plan of buying on the dips. And then you can talk about the risk, right? And then determine how much do I buy on the dips. And then the third piece is really taxation. So I have, and he knows who he is if he's watching this, but I have a good friend of mine that has told me that back in 2008, he took all those losses and just moved them to different companies. Like, if you didn't know this, if you have the Vanguard S&P 500 fund and you want to keep the S&P 500 fund because you don't want to miss out, but you want to take the losses in that fund, all you do is hit sell, buy the Fidelity S&P 500 fund. You're in the same investments, but you switched companies, therefore you get to take the loss. So you don't skip a beat in the market or in your investments. You get to take the loss and carry forward those losses for years to come. And yes, if you have no gains to offset the losses, it's $3,000 a year. So most people are like, well, what good does that do me? I'm going to take $3,000 a year. It's like, yeah, but if you had somebody taking gains for you, so then the gains, you don't owe taxes on because you're going to offset the gains with the losses, with the carry forward losses. So it's so important that you have somebody looking out for you when in taxation, when you were talking about a market drop or market volatility, because there's so many things that you can do to take advantage. Taxation is one of them. Buying is one of them. Roth conversions is one of them. So we have certainly been making our list, which we always do, of clients that should convert to a Roth when the market is down. And for those of you that don't know what that means, should I get into it now? Or should I save that for a different day? I feel like there's so many videos.
We got a lot of videos on Roth conversions in our
YouTube.
so they could go ahead and check that out. But it's just an option that we can look into to help you save on your taxes
Down the road.
down the road. Yeah.
Yeah, and you're going to pay some taxes now, so why not convert when the market is down?
Right.
Lessen your taxes. So that's the whole point. So again, there's many things that you can do when the market is going down. In preparation right now, you need to be working on the plan and the risk. And that way, when it happens, and we don't know when it's going to happen, every single day could be a brand new high for the next 6 months. You just don't know. So it's easy to look back. Your hindsight is always 20/20. So it's easy to look back and say, well, that was the all-time high. You know, didn't you know there was a market correction coming? And it's like, well, of course, the market correction is coming. But what if you're here and there's new all-time highs for the next 6 months, and then you get your market correction?
Right.
You're right back where you started because the market went up first, right? So you don't know how high the market is going to go. Man, I wish I did.
I know.
That'd be so nice.
Yeah.
But nobody knows that. So you can't time it like Beth said. You can't get out, get in. You can't, because there's always a reason why it could be going higher. There's always a reason why it could be going lower.
Correct.
So all we can do is prepare for the market downturns. And yes, it is a 50-50 shot pretty much. That's going to go down every single day. So we need to take some gains in preparation, especially if you're that lower risk tolerance. We need to take some gains. We need to look at your tax situation. We need to reassess risk and reassess income. Make sure your income plan is always moving forward. So getting ready right before market downturn is smart, but it kind of should have already been done.
Correct.
You know, so we
Your
certainly...
advisors doing what they're supposed to be doing.
Right.
They would have prepared you for this.
Very true. But yes, and then there's the camp that can you make money when the market goes down? We've mentioned this in so many of our lives, but I do feel like I always mention it like towards the end.
You do.
So
It's pretty consistent for Amy.
So maybe we start talking about it in the beginning.
Okay.
Beth,
All right.
how you can make money when the market goes down. I mean, there's a lot of people. You got to be risky though. You got to be willing to bet against the market, which isn't a good feeling. I got to tell you, because if you're wrong and the market keeps going higher, you're like, dang it, the market's going higher.
Who would have thought they would be upset?
Right. So there's ways that you can make money when the market is going down, for sure. And we talk about those ways in a different line.
So if you are an advisor or in the financial industry and you want to be able to do some of these things, but where you're working is not
Oh, my mic wasn't on.
open to that, but I think it's catching you because you're down here. I know, I saw that too.
Is it even on?
It is
It is on.
So it's going to be here, fine. Oh, and she's dropping it. Look at
sorry.
that.
You know what? I'm just going to set it up.
Just leave it right there, Amy.
Okay.
How about we don't touch that right now?
We're not
right?
going to.
So if you're in the financial sector and what we're talking about is something you'd like to be able to do, and where you're at doesn't allow you, doesn't look for that because they're focused on other things, and you want to be able to help your clients and your families better, give us a call or send us a message. You could respond to this video. You can reach out on Facebook or on LinkedIn as well. I'm even on TikTok. I'm not. Well, I am, but the Nova Wealth Management is on TikTok. Meaning you can reach out to us there and to see if it's an option for you of maybe you want to bring your business or just yourself, I should say, over here to us. We are happy to have those conversations. We specialize on being a small boutique wealth management firm where we not just do investment management, we also do financial management. There's a difference. And that's your spot for us. Spot for you if you see fit.
For sure.
Also, on Fridays, if you want to join us, you can send us your pictures if you'd like to. We always wear red because we remember everyone deployed, so you can wear red with us. We always remember our veterans and our first responders because our first responders get deployed as well.
Yes. Very good.
I feel like Bob Barker.
So
don't forget to
stay
spay
near
your pets. with my ending with
Out.
that. Anyway, anything else from you, Amy?
I don't think so.
All right. Thanks so much. We're going to see you guys
Have a great
next week.
weekend.
Bye.
Bye.